Joining us for a further look on what's playing itself out on that market scene is independent analyst Jacques Pretorius. Jacques, a happy new year to you. Thank you for your time this afternoon.
Thank you very much. Same to you. Thanks for having me.
All right, Jacques, I think we are still expecting a trickling in of, traders and for trade desks to really be completely online. But what we are seeing here is red screens all around, red screens in Europe, as well as red screens here in Johannesburg. I'm keen to get your thoughts on what's driving, market sentiments this Monday afternoon.
Okay, yes, bit in the red. I think the euro has kicked off very slowly. I think a lot of people aren't back yet. Perhaps we'll see more action coming as soon as the school starts from Wednesday onwards. But certainly, yes, we had a bit of a rally towards the end of last year, especially November, December, and we're cooling off a bit right now. I think year to date, the all share must be down around about 4% at the moment. But yeah, there's obviously uncertainty regarding the world economy. I think it's also going to be a year where geopolitical risk is a big factor in markets. And I think for that reason, we see this caution to the start of the year. I do, though, still believe that we are going to see interest rate cuts during the course of the year, possibly pushed out slightly right to the end of the second quarter. But certainly that would support the markets to some extent. And especially, right, I believe in other parts of the world apart from the US. So I believe that emerging markets could have a better return this year compared to the developed markets. It might not be 20%, but certainly there is a possibility of a re-rating in this market.
I'm actually keen to get your thoughts on what geopolitical risk is doing to the price of oil right now. We did see quite a spiking towards the end of last week. And I'm wondering, as we all kind of sit back and to see if there might be any retaliation from the Houthis, are we expecting that oil may put us under pressure? And what does that do then, for our prospects with interest rates, Jacques?
Yes, obviously it's going to be a cat and mouse game, I believe. On the one hand, you've got a slowing of the world economies. I think I'm of no doubt that we'll see some slowdown in the US economy going forward. Perhaps not recession, but certainly a definite slowdown from that point of view. And that's where we've seen the weakness coming through on the oil price. And then the converse to that, obviously, there's political risks and volatility right in the Middle East. So I think it's going to be a story of the whole here, right, playing off against one another, and it's very difficult to judge that going forward. I would hope that we don't see an oil price above the $80 again. It won't be good for inflation. It'll hold interest rates much higher for longer. So on balance, I'd prefer a much lower oil price, perhaps the economy having a bigger impact, right, than the political risks.
We also are expecting some recovery from China. I think all of us waiting with bated breath there. But we saw them today, holding their medium-term policy rates, steady. I'm keen to get your thoughts on this decision. I think many people are anticipating more stimulus from this economy, but it seems that it won't be in this way.
Yes, I think most of the players expected a bit of a rate cut there that didn't happen. And just remember one thing, that that's not the only tool that that China has to stimulate the economy. I think there was an announcement last week of a $50 billion right stimulus package being announced. And I think they're slightly concerned, right, that if they do start cutting rates early, they don't have ammunition right later in the cycle. So I believe that they're going to wait for the US, right, to perhaps get closer to a rate cut before they'll actually use their interest rates as their stimulus tool. So I think short term we'll see some more stimulus coming through from them, but in the form of stimulus packages, right, in money creating money as opposed to interest rates at the moment.
With that said, I think we're all watching for various members of the Federal Reserve to be giving various addresses this week, Jacques. Looking for clues. Are we looking for clues? I think the data seems to be clear, and we know that we will see rate cuts sometime between June. But, are we expecting that members of the Fed will be giving new clues, different clues about the interest rate trajectory?
Yes, I think it's The information coming out recently was a bit controversial. So we saw the CPI a week or so ago slightly higher than expected. On Friday, we saw the PPI slightly lower than expected. So there is still a bit of uncertainty from that point of view. I see one of the figures that we do look at is the private consumer expenditure. That's coming off. So that indicates to me like there is a bit of a slowdown in the economy as well. But funny enough, the American economy is actually holding on pretty well. So perhaps we might still have a soft landing and not a recession going forward. And they're holding out perhaps for that. But I do believe that somewhere in the second quarter of this year, we'll see our first rate cut out of the US.
What we know also happening this week is the World Economic Forum. Are market participants at all looking for something specific to come out of the conversations here? Is this all an event for market participants?
Yeah, look, I think it's a difficult one. I think the theme, right, is to create trust in the world again. I think we've had all this controversial um wars looming around. I think people want peace in the world. I don't know if this is going to assist it. I hope it really does. A more peaceful environment will give us a more stable economic outlook, and perhaps markets can perform on the back of that.
Jacques, an interesting one also, I think what we saw in 2023 was bonds being a favorable, asset class just by virtue of what was happening with our interest rates. I'm wondering if we are anticipating equities to rebound a little bit in 2024, and what would be the driver of those rebound or that rebound?
Yeah, so I think to a large extent, the rebound in equity will come from a re-rating of markets, right? So I believe that the markets, especially outside of the US, is exceptionally cheap. And to a large extent, the US is also driven by their big tech stocks last year, right? So the mid cap stocks and the smaller cap stocks look a lot cheaper priced. I think there's an opportunity once you start cutting interest rates that the markets can start re-rating. So perhaps we'll see a bit of a broader re-rating in this market in the second half of this year. Some of the mid-tier and second-tier companies doing a lot better. And that's why I think a lot of players in the market are saying that this is going to be a stock pickers market. I think the value lies in those mid and smaller cap companies, and you have to do a bit more homework on those specific counters.
With that said, Jacques, SA Inc., we're out there, Davos, trying to sell our investment case. We know our stocks are dirt cheap at this point, but I'm wondering if that may see, investors looking upon our JSE a little bit more favorably, and we may see some inflows in terms of investment there.
Yes, I think we've seen absolutely huge outflows, right, in the last year or so. Reg 28 last year was one of the driving factors as well. We have seen at the start of this year the figures coming out from December, international investments still going out of the country, so we're not seeing flow towards our local equity. But I do believe, right, that the markets go through cycles, and certainly a cycle where interest rate cuts come through, the market tends to favor the emerging markets, and we fall in that basket. So we're going to we will get some spin-off, right, of money flowing towards South Africa, and because we are so cheap, we can re-rate quite easily. So yes, I'm very bullish on that from that point of view, right, from a rotation and flow. Is the returns going to be great? Plus 25%, I don't think it's going to be that much. I think we're sitting in double-digit figures, perhaps between 10 and 15% for the year.
Now, in the spirit of a stock picker's market, Jacques, keen to get your stock pick for this afternoon. Which counter are you liking?
Okay, I'm going to go for the property sector. I see that the property sector started recovering quite nicely in the last 3 months now. It's one of the better performing sectors. Perhaps a bit late on the trigger. I would have liked being in there slightly earlier. I thought that the property stocks would start performing much better this year. So I'm looking at Redefine, right, as my choice today, around about R4. It's going to give you a yield of close to 11% for the next year. There is still a bit of risk, but on their loan to value, which is quite high. But given the fact that interest rates are coming off, a lot of that risk will dissipate as the year progresses. And I believe that's one of the ones that will perform well.
Well, it's been a pleasure speaking to you today. Thank you so much for your time, Jacques. That was independent analyst Jacques Pretorius with your midday markets update.